In general, any idea, so if we think about term life insurance, does anyone know what term life insurance is? No? All right, it's the one that you probably would be most familiar of. It's the if something happens. For a term of time, you're essentially renting a death benefit. So let's say that 25-year-old Chris got married and 30-year-old Chris has kids. If I want to have insurance that lasts for 20 years while my kids are at home, I can buy a term policy. Now, one way that I can pay that price over those 20 years is to have an annually renewable contract. I just pay a larger amount every year based on my age, right? So minimum upfront, a little bit more every year. Or you can pay a level premium. So you pay a little bit more in that early year, but it stays level for those 20 years. So this kind of overpayment that you did here helps subsidize the fact that it's a lot cheaper when you're older, when the actual expense of the insurance is higher. Does that kind of make sense? So term is temporary. It's good for a temporary need. Something like when my kids are grown up, I may not need as much insurance anymore. Because once they kick me out 20 years from now, if I want to go back and get some more coverage, I'm going to be up at this price point, right? So term is good for temporary needs. Permanent insurance is another kind. It's one where also you would pay higher here for a fixed period of time until you'd be done paying premiums. But this excess contribution in the early years is invested by the insurance company so that you get a death benefit no matter when you die. It's kind of like buying a house instead of renting a house. Yeah. What does my insurance need look like? Well, my insurance need today, I'm thinking mostly about needs, replacing my income if something happens to me for my kids and for my wife, right? 10, 20 years from now, technically I've had 10 to 20 more years of earnings and savings. My balance sheet, the money that is now, that I haven't earned yet, the potential money that I haven't earned has now been realized and captured, right? So technically my need for insurance has gone down, right? What you find for a lot of clients is that those needs get replaced with other needs or other wants. So people in their 50s have different sets of why they buy insurance than maybe someone would in their 20s or 30s. But you're totally right. If you were to just purely look at it as the need for my kid, the need for insurance would actually slope downwards each year that I survive, right? Because I have fewer years to cover. So if you go through your term and you survive, which is the most likely scenario, yep, you don't get anything back for it other than the peace of mind that if something had happened, your family would be taken care of. That's right. So that's where permanent insurance, coming back to that piece, that's where people tend to think about having a combination of the two in my experience. Term is the default because it's the cheapest. If you're a healthy 30-year-old getting $1 million of term insurance right now, it might be like $35 a month. So it's like it's not super expensive, especially if you're healthy. If you're getting permanent insurance, now you're changing it from an if to a when. And so think of it this way. It's kind of like buying the house, as I was using that analogy. You got to structure a mortgage payment to pay in enough over a certain period of years so that by the time you're done paying in, the insurance company, based on the curve, the average curve here, knows they're going to have enough money to pay your claim someday. And so what you find is, and I know I want to be cognizant of time here because I could go on way too long on this. When you look at defining the amount of need, I think is the most important thing. What most of you are going to find is that your group insurance through work, whatever employer you have, will give you some options for some life insurance. So it may be that you can check a box, and especially if you're not in the best of health or have a condition that would affect your curve here, the rates that you get through work may be more advantageous than what you could qualify for as an individual. But most of the time, the amount of coverage that you can get through work is not enough. So there usually is some amount you're supplementing outside. But the combination of those, and this gets back to your question earlier of like, if you have multiple insurances, is that an issue? At least in the life insurance bucket, they would all pay out. It's kind of like a light switch. You're either here or you're not. So just from a concept of insurance, that's what I think, if to leave one takeaway, that present value of earnings, I would recommend that you think of it that way. And also remember that most of us in this room have more potential than we do balance sheet, right? Pretty much all of us and all the money we've sunk into our education has yet to bear fruit.